Everyone, and welcome to the OCBC Premier Banking Market Outlook webinar for 2023, and a Happy New Year to all. My name is Yvonne Chan, and it's my pleasure to be hosting you live. And before we begin, I would like to share some housekeeping tips on how you can participate in our webinar tonight. We recommend that you use Chrome or Firefox to view today's session. And if you encounter any audio or visual quality issues, simply refresh your browser. You can also resize the panels and move them around your screen according to your viewing preferences. Now, tonight, we would also like to invite you to take part in a series of polls, as this gives us a sense of where your current investment sentiment is at. So you can scan the QR code and submit the answer that resonates with you most. We will also have a live Q&A session during the webinar, so feel free to send in your questions, and our OCBC wealth experts will do their best to address as many as they can within the allotted time. Our webinar tonight is titled 2023, Recovery or Recession, and I think that title is very apt. 2022 was a very challenging year for the global economy and markets, with many geopolitical and economic events causing much uncertainty and turbulence. And after almost 12 months of battering by high inflation and rising interest rates, the key question remains: are major global economies headed for a deep recession? Well, stay tuned, as our panel of experts will be sharing their views on the market outlook for 2023, as well as highlighting the potential investment opportunities not to be missed. But before that, let me invite Mr. Bob Ng, the head of Personal and Premier Banking at OCBC Bank Singapore, to come on stage to kick us off with his opening address. Bob, please.
A very good evening to everyone. On behalf of OCBC Premier Banking, I would like to thank all of you for taking the time to join us this evening at our webinar. 2022 was an extremely challenging year for the financial markets and for investors. After close to a year of being battered by inflation and rising interest rates, major economies may be headed for a recession in 2023. Even though a recession could impact earnings negatively, there may be a silver lining. A recession could also tame inflation and result in the Fed pivoting to a dovish stance, which may ironically help the investment markets to stage a recovery. Nevertheless, in the first half of this year, investors need to brace for more uncertainty and market volatility. Inflation rates have come off from their highs, but they remain elevated and could hurt consumer spending and force central banks keep monetary policy tighter for longer. The battle against inflation will be key to how markets perform in 2023 and beyond. The ongoing crisis in Ukraine, which will be almost 1 year in the making and with no end in sight, is another source of market uncertainty. China's reopening after it eased COVID restrictions recently is another key event that will affect the market outlook in the coming months. China is facing short-term pain as it reopens its economy and sees a surge in COVID cases. But when the dust settles, the economy is likely to see a good rebound. This will present opportunities, but it may also mean inflationary risk for the rest of the world. Our webinar this evening, we will address some of the key concerns that investors have and offer guidance on what you can do to overcome the headwinds. Despite the current market uncertainties, we do not think that investors should avoid investing and stay in cash. Given the uncertainties, a dollar-cost averaging strategy or spreading fresh investment into the markets over the coming months may be a better approach than timing the market or staying out altogether. Our fundamental view about wealth management remains unchanged. For prudence, investors should always have a balance of assets in their portfolio, including exposure to equities, bonds, and even commodities. Diversification is especially important at this juncture to protect investment portfolios against downside risk. I believe that with the help from your relationship manager, you'll be able to invest sensibly while managing the risk without missing out on the opportunities. This evening, we have with us 3 members of the OCBC Wealth Panel who will share their views on the outlook for the economy and the markets. We also have a speaker from Lion Global Investors to talk about ESG investing. In recent years, there is a growing emphasis on non-financial factors as well to ensure that the environment, society, and minority shareholders are protected too. This transition to a more environmentally friendly, socially responsible, and climate-resilient global economy will introduce new opportunities for investment and growth. ESG is clearly a mega theme that investors cannot ignore. As we start a new year, our commitment to OCBC Premier Banking is to continue providing you comprehensive wealth solutions and enhancing your banking experience with us. We look forward to journey together with you for the rest of 2023 and the years beyond, both in good and volatile times. Thank you, and please enjoy the rest of the evening.
Thank you, Bob, for getting the ball rolling for us today. Let's proceed with the next segment of our program. I would now like to invite Kevin Teo, the Head of Environment, Social and Governance from Lion Global Investors, to give us an overview to investing in ESG. Kevin, please.
Thank you, Yvonne. I am Kevin Teo, the Head of ESG at Lion Global Investors. You may have heard of ESG, but some of you may not know what exactly it is and why you as an investor cannot choose to ignore it. ESG is essentially an acronym. It stands for Environmental, Social, and Governance. Taken loosely, ESG investing, sustainable investing, and socially responsible investing are one and the same. Historically, investment decisions have often been made, but mainly based on financial factors. However, in recent years, there is a growing emphasis on non-financial factors as well, to ensure that the environment, society, and minority shareholders are protected too. So in a nutshell, ESG is a good thing, and it is something that we should all keep in mind. The key idea is to invest in companies with sustainable business practices or are progressing towards being sustainable. This would also lead to a better and more sustainable future for our society. Now, let's take a look deeper into what ESG stands for in ESG investing. Let's start with E, or environment. It includes considering factors such as climate change risk and carbon emission, resource depletion, clean water, energy efficiency, waste and pollution, recycling, and deforestation, just to name a few factors. S, or social, can include considerations like working conditions, child labor, slavery, the impact of a company's business on local communities, health and safety issues, human rights and human capital development, corporate diversity and inclusion, etc. And finally, G, or governance, may take into account shareholders' rights, voting procedures, board independence and board diversity, corporate transparency, executive compensation, and corruption. What is heartening is that more and more companies are embracing ESG and making business decisions based on them. This is because of tightening regulations, and the companies recognize that they must play their part in improving the world and ensuring a more sustainable future for our society in order to have a sustainable business. There is also a growing realization that more and more global fund managers who control billions and even trillions of dollars in money will shun companies that do not embrace ESG and could favor a company that capitalizes on ESG opportunities. In the past few years, we have seen an exponential increase in ESG investments. For instance, according to Morningstar, the total assets of funds which has an ESG focus has increased phenomenally from US $500 billion in early 2019 to US $2.7 trillion in early 2022. Clearly, ESG is a theme that investors cannot ignore and should not ignore. ESG sounds good as a concept, but how would one systematically incorporate ESG factors in the investment process? Global financial data providers offer ESG securities ratings and benchmarks to screen good ESG names from the bad ones. This has helped to improve and expand investors' ability to integrate ESG into their investment process. Now, clearly, the transition to a more environmentally friendly, climate resilient, and socially responsible global economy will introduce new opportunities for investment and growth. Companies that adapt successfully to this transition are increasingly likely to benefit from evolving consumer preferences and regulations. In a nutshell, investors cannot choose to ignore ESG. It could be part of your overall investment portfolio and something you invest for the long term. ESG is a game changer. It is not only going to change the way we and our children live, but also the way fund managers invest their money. I hope you have found my short presentation about ESG useful. To find out more, do speak to your relationship managers to explore further about ESG and how you can invest in this mega theme. There are investment options available. Let me conclude by thanking you for your time in listening to my presentation. I wish you all a very happy and prosperous 2023.
Thank you, Kevin, for your insights into ESG investing. Now, before I introduce our panel of OCBC Wealth experts tonight, I would like to invite my online guests to take part in this poll session so that once again, we can get a sense of where your current investment sentiment is at for the year 2023. So let's flash up the first poll question on screen, please. Do you expect a global recession in 2023? We have three options for you. A resounding yes, it's coming. No, not sure. Please select the option that resonates best and click submit. Okay, so it seems like 100% of you. Wait, okay, 91%. More than 90% expect a global recession, so a pretty pessimistic crowd there. 91.44. Okay, let's move on to question 2. Are you bullish or bearish about the investment outlook for 2023? Well, given that your response to the first question was a resounding 91%, yes, a global recession is coming, let's see where you're at for the investment outlook. Okay, so yes, I mean, that's in line with expectations, I guess. 71% bearish, 1/5 of you bullish, and a very small party standing neutral. And let's move on to our third poll question. What do you see as the biggest risk for the global economy and investment markets in 2023? So we have 5 options for you. Unfortunately, we don't have option number 6, which says all of the above. So please choose one. I think the options are pretty familiar. Persistently high inflation, maybe some missteps by central banks. Sharp economic slowdown in China. Well, China is reopening now, so we could be seeing something very opposite to that, and a sharp economic downturn and more geopolitical risks. So more than half of you believe that persistently high inflation will continue to feature strongly in 2023. Okay, that's very interesting. Thank you so much for taking part in that poll, because this will certainly inform our panel of experts, and let me introduce them this evening. We have Ms. Selina Ling. She's the head of Treasury Research and Strategy at OCBC Bank. Welcome, Selina. And next to Selina, we have Mr. Vasu Menon. He's the Executive Director of Investment Strategy and Wealth Management at OCBC Bank. Welcome, Vasu. And rounding up our panel this evening, we have Ms. Carmen Lee, who's the head of OCBC Investment Research at OCBC Bank. So once again, a warm welcome to my panelists. Let me quickly run through the poll results, right? So are you expecting a global recession? 90% says yes. bearish on the economic outlook or investment outlook, so 71%, and 50% of the audience tonight believes that persistently high inflation will continue to plague the global economy and investment markets. Against that backdrop, Selena, could you tell us, in your opinion, the key challenges confronting the global economy this year? Are we headed for a global recession? Is it imminent?
Well, I think at this juncture, the audience has really spoken. It does smell and feel like a recession is upon us. But actually, if you look at the IMF forecast, they are not quite calling it a recession yet. But of course, the course of 2022 have proven the IMF and World Bank, a lot of the other institutes wrong when it comes to forecasts because they have been consistently downgrading the forecast. So it's very likely that we could continue to see this play out in the early part of 2023. They could be too optimistic. And in fact, if you look at my next chart, it does show you that our house view as where growth would be is actually a little bit more cautious compared to the IMF forecast. I think the key challenge here really is that the major economies are going through a period of synchronized slowdown. So the Eurozone and the UK are likely to be in recession this year. We think the US probably is going to escape maybe by the skin of their teeth. It all really comes down to what the Fed will do. And actually, if you look at history, it's not on the Fed side. Whenever they do aggressive tightening, 0 to 5% as what they have been telegraphing, they typically will tip the US economy into recession. So with global growth slowing down so dramatically, it's really a matter of hit and go. Whether we will actually escape a recession. Anything that is around 2% or lower would effectively be like a recession for the global economy. So the two drivers I think we have to watch out for. First is the Fed policy, and you can see this in my next chart. Like I mentioned earlier, history is really not on the Fed side. When they do aggressive tightening, they will probably drive demand down so fast that growth is going to stumble. The other factor we really have to watch out for is really what happens to inflation. Because if you look at the central bank's tightening, it's not just about the Fed. Because you have other central banks, European Central Bank, BOJ, and all the others also tightening. And I think what they do from here, just like the Fed, will come down to where is inflation going to be this year. If you remember last year, there was a lot of talk about inflation being persistent rather than transitory. I think the outlook for this year is going to be that inflation is going to come off because some of the supply chain disruptions are resolving themselves. And you can see from these charts, actually, some of the supply chain problems that we had that really, really hit the global economy back in 2020 has kind of like come off. But the problem is they are not back to pre-COVID levels yet. So there are still some structural elements to the supply chain disruptions. I mean, for instance, the Russian-Ukraine war is still ongoing. And if you look at US-China tensions, although there are signs of some dialogue that's ongoing between their leadership, but effectively, they are still in strategic rivalry over key things like the chips, for instance. So I think inflation is going to ease because of the high base effects from last year, but it would really come down to whether commodity prices stay at relatively subdued levels. And if you look at oil prices, for instance, currently, because markets are very fearful about this whole global slowdown story, so they are trading at relatively subdued levels, way below $100 per barrel. But of course, now that China is reopening, there are some fears that China may actually drive up demand in the later part of this year, and that in turn could mean fresh shocks to the global commodity market. So if you look at the region in perspective, actually, what we are seeing is that it's going to be disinflation. Disinflation means that inflation rates probably peaked in sometime late last year. They will be coming off slightly, but we are not expecting deflation, meaning that we are not going to see outright negative numbers for inflation. And I think if you look at the region, actually Asia-Pac has relatively low inflation compared to the other regions. Maybe because we are a little bit more self-sufficient in terms of the supply chain, especially on the manufacturing front. But it doesn't mean that monetary policy tightening is over for ASEAN yet. So my next slide would really tell you that, commodity prices are very important. Last year, because of the Russian-Ukraine war, wheat prices and a lot of the other, sunflower seeds, etc., all shot through the roof. We are expecting some normalization. it's no longer just a story about oil, but we have to watch food quite carefully. So I'm sure all of us, we buy eggs and chicken from the supermarkets. When we had that chicken supply problem, we could accept the price increase.
Yeah.
But that supply has resumed. But I don't think the prices in the supermarkets have come off at all.
No, the supermarket chicken still costs $14. What happened to $7?
So I think there's a little bit of that, pent-up demand contributing to firms passing on some of the cumulative costs over the last 3 years. And because so far demand has been holding up quite well, at least in the Singapore economy, the businesses actually feel that they are in a position to pass on more of the cost. And of course, we had the GST hike as well.
That's right.
January this year.
Lots of things rising in terms of prices as well. But I wanted to ask you a question on stagflation. But before I get to that, you also did mention China. So, all eyes on China now as this world's second largest economy reopens. What do you think China's growth path is going to look like in 2023? And what sort of impact will we see on the rest of Asia?
Okay, if you had asked me this question 3 months ago, I would have said that first half was going to be a slow story because they're not quite ready to abandon their zero COVID policy yet. And then you'll see a pickup in the second half.
But
now, guess what?
Yeah.
They actually surprised markets because they announced the reopening a little bit earlier, in December itself. So from what I understand, actually, COVID infection waves are really rampant in parts of China now. It could also mean because of the rapid pace of reopening, they may actually reach herd immunity a lot faster than what we experienced in ASEAN when we reopened last year. So there are pros and cons of that. The cons of that, of course, is that there will be some short-term pain, right? Because infection levels are high, it's going to dampen, and people are not going to go out and travel and shop. And industrial activity may also be affected because a lot of workers may actually be on MC, for instance. But it will have depressed, I think, the November-December activity, dragged down 2022 growth to a large extent. But I think once we ride this peak, in the first quarter, you're probably going to see a sharper pickup in growth for China. So actually, the table I showed you earlier about our growth forecast for China and the region, it did already anticipate that China is going to reopen, except the timing has been shifted forward a little bit. What this means for Asia, it's a bit of a double-edged sword, okay? I think a lot of the tourism-dependent economies like Thailand and Malaysia and Indonesia and even Singapore are looking forward to welcoming Chinese visitors back to the shores.
Yes.
That's going to be very good for the aviation and hospitality sectors. But on the other hand, there's also some worry that it may drive up prices in the longer term, right? Because the demand is going to come back, and it also means that they're going to demand a lot of the services and consumption of all the different goods that they buy when they are here. So it could mean that inflation could be a lot more persistent again.
So many factors to watch out for, but I think overall the sentiment is pretty positive, right, on China's reopening as well as investment opportunities that will be featured in that market. How do you think ASEAN economies will fare then, Selena?
Okay, ASEAN economies had made the transition to an endemic COVID environment earlier, in the last 6 months or 9 months or so. So they are benefiting from the recovery of the services side. But the engine that is manufacturing electronics, that seems to be slowing down a little bit. So global demand for semiconductors, for instance, have been generally contracting, which is why the manufacturing PMI numbers have been in the rate of late. I think going forward, one key thing to look out for really is on the labor market side, because we are starting to see cost of manpower actually ratchet higher. Some of it, of course, is due to the pandemic and workers returning home and not quite coming back in the same way that they were pre-COVID. But you can see from this table here as well, a lot of countries have raised minimum wages in order to cope with higher inflation. So it's a little bit of a chicken and egg situation, right? If you have high inflation because of commodity prices, workers demand higher wages. If workers have higher wages, companies feel compelled to pass on more of that cost increase, and then it contributes to inflation again. So this wage price spiral is something that policymakers are very concerned about. Although we don't really think that we are on the brink of that happening yet, but it is something that we have to be very careful of. And I think the poll shows that most people are very, very cautious that inflation is still going to be the bugbear for 2023, just like in 2022.
Yeah, there's certainly a lot of wariness there. What about the outlook for our economy here in Singapore and the Singapore dollar?
Well, actually, if you look at Singapore, we've had a fairly good year last year, right? Growth was around 3.8%. That's in the higher side of the official 3 to 4% range, although it's a slowdown from the 7+% we saw the year before. But I think we have to brace ourselves that because the manufacturing electronics engine is really slowing quite significantly. We're going to be like a plane that's going to be flying with one engine down. So we expect that the services side will pick up mainly because consumption is quite strong. I mean, if you go out to the shopping malls and restaurants, you know it is getting quite crowded.
Yes.
And I think it will get more crowded when the waves of Chinese tourists arrive. I was at Malayan Park last weekend, and I can tell you there is a nice buzz to the place there already, right? And of course, so what that means is that for F&B and a lot of the hotels and the other tourist-related type of industries, they are expecting that there will be robust demand. But on the flip side, of course, certain other sectors, real estate, for instance, because Singapore property market has been facing cooling measures and interest rates have been on the rise, sentiments are slightly more dampened in some of those areas. So it's a very mixed bag, I would say, for the services side, but generally, the services sector will be a lot more resilient compared to manufacturing.
So some tailwinds there.
So I have another last slide just to share with you, which is really that we have this proprietary SME index. It kind of gives you a very granular breakdown of how the different sectors are doing for the smaller and medium-sized firms. And you can generally see that most of them are in the green neutral zone. That means they're either expanding or they are fairly neutral in terms of their outlook. But as everyone is waiting to see, we have the Singapore budget coming up on the 14th of February. Is the government going to be more generous in terms of the help for households with cost of living issues? Are firms also going to get additional help with respect to manpower and also higher cost? I think that one we really have to wait and see.
Well, it's held on the 14th of Feb, a love day, so maybe the government will show us a little bit of love this year. We will wait and see. Thank you for taking us through the macroeconomic outlook for the global economy, China, ASEAN, and Singapore, Selina. This, again, is a reminder to our guests. If you have questions for Selina later on, please do scan the QR code for the Q&A session and key in your questions. And we'll try to get Selina to address as many as we can within the allotted time. I'd like to turn my attention now to Vasu. So once again, our audience sentiment tonight is 71% bearish for the investment outlook and 50% believes inflation will continue to be sticky. Can you take us through, perhaps, Vasu, very quickly, the performance for markets in 2022 and the key challenges that we are likely to see for 2023 then?
Okay. Yvonne, I think I understand where the audience is coming from. After a really bad year in 2022, I think the feeling has spilled over into the early part of 2023, right? So if you look at how the markets have performed in 2022, just to pick out some learning lessons from how the markets have performed. Global equities down by 19.5%. Now that's the worst performance from equity markets, global equity markets since 2008. Global bonds are down by more than 16%, and that is, again, one of the worst performance in bond markets in its history, right? And both global equities and bonds fell at the same time. Now that's rather unique because in the last 25 years, it's only happened twice. And that gives you an idea of the distress that went through the markets in 2022. Now, if you go down in terms of regions, you see that, Asia ex-Japan was the worst performer, down by more than 20%. And that's partly because of the slowdown in China, partly because investors were de-risking, and clearly Asia took the hit along with China. And, second worst performer was actually the US stock market because the Federal Reserve was pushing up interest rates quite sharply. Bond yields in the US surged. That hurt the US stock market as well. But Europe and Japan were not spared either. I mean, they were also down fairly sharply. Now, in terms of sectors, the only, bright spot last year in 2022 in terms of sectors was the energy sector, up 41%. And that's because oil prices, benefited from supply disruptions, the war in Ukraine. But even then, oil prices shot up to more than $100 a barrel in June, and then they pulled back sharply as well. So oil was not spared, depending on when you had entered the markets. But the one sector that took a very bad beating in 2022 was the technology sector, down by more than 30%. And I think technology did very well in 2020 and 2021. After COVID, a lot of individuals were gravitating towards, digital economy. That benefited the tech sector. But the technology sector took a beating in 2022, partly also because bond yields were on the rise. And technology is seen as a long duration asset. So typically when an asset is long duration, interest rates are going up, that asset tends to face a lot more pressure, just like a long duration bond. So typically investors see technology as a long duration asset. Bond yields shot up quite significantly, more than 200 basis points last year, and that weighed on the tech sector that took a really bad beating. So some of the big names on Wall Street came off very sharply. Now, gold had a roller coaster ride. In March of 2022, it was as high as $2,000 an ounce, and then it came tumbling down to close to $1,600 an ounce, and then it rallied again by about 16% to now just above $1,800 an ounce. So, but nevertheless, gold managed to eke out a small 1.5% return in 2022. But nevertheless, it was a very volatile ride for investors. Now, looking at 2023, which is what our viewers are here for, but I just wanted to share 2022 to put in perspective, which is why I understand why investors, feel the way they do. I think if I had to characterize what's going to happen in 2023, it's going to be a tug of war between the headwinds and the tailwinds. So to start with, on the headwind side, you've got high inflation, and the audience has spoken, right? That was the number one risk factor that everybody highlighted, persistently high inflation. So that remains in the spotlight. Investors are very worried about inflation. That's the one number that everybody's going to look at very, very closely for the next few quarters, right? For the next few months, rather. And along with that, rising interest rates. Interest rates have increased very significantly. At the start of last year, the Fed fund rate was 0%, and now it's 4%. So the Fed has pushed up interest rates by 4 percentage points. And we see the Fed pushing up interest rates further this year. We see potentially another 75 basis point rate hike from the current levels, with interest rates in terms of the Fed fund rate peaking sometime in probably March, right? And on top of that, I think the other risk factor that has come to the forefront, again, that came through quite clearly in the poll, was the fear of a recession, right? So you can see investors are very cautious about the global economic outlook. And yes, the recession fear is a new thing. In 2022, the markets are very focused on inflation and interest rates, but now recession has come to the forefront. And I think it's not just about whether we will see a recession. It's more than that. It's about whether it will be a shallow recession or whether it will be a deep recession, right? So a recession is, somehow kind of given. The markets expect it to happen.
Right.
But will it be a shallow one or a deep one? Because if it's a shallow one, it's not so bad. Investment markets will, breathe a sigh of relief. But if it's a deep one, then that's going to be bad news for the markets, right? And, along with that, we have corporate earnings. Corporate earnings forecasts are still fairly bullish at this juncture. Analysts are still quite positive on the outlook for earnings. We've not seen them factor in sufficiently recession risk. And so we feel that we need another 3 to 6 months of a reality check in terms of earnings. Earnings will probably come down, will be revised down. They've not been revised down sufficiently, but they'll probably have to come down. And that could, be a shoe that could drop in the markets and cause the markets to see another leg down in the first half of this year, right? And of course, China uncertainties. Everybody's worried about how the situation in China is playing out in terms of the surge in COVID cases. That's clearly going to impact China in the first half. But once I think things stabilize in China, China will regain its footing, and it could see quite nice growth after that. And of course, we got the US presidential elections this year, and it remains to be seen who will be nominated presidential candidates on the Democratic side and Republican side. So expect fireworks. And very often in the run-up to the presidential elections, geopolitics comes into play as well. China bashing was a theme in the last election, so it remains to be seen whether it will remain as a theme in this time around. So on the flip side, Yvonne, is other tailwinds. And this is a rather unique situation. Here we are talking about a recession, but at the same time, in the last 2-3 years, we've all been caged up, and you see reopening taking place, pent-up demand, revenge spending, and so it's posing a headache for central bankers because while they want the economy to slow down, inflation to come down, we're all making it more difficult for that to happen. Even though prices have gone up, we still continue to buy our chicken, because we've been cooped up for a long time. We need the chicken, right?
I see what you did there.
So, and the labor market is very strong. In the US, 4.5% wage growth, very strong labor. So it's a very unusual situation. Typically, when you have a recession, we talk about job losses, wage declines, a mood of pessimism in the market. Here we have a different story.
Yes,
after 2.5 years of COVID, it's like revenge spending, a little bit of optimism in terms of spending. Labor markets are tight, and companies are still hiring. You don't see massive layoffs yet. So it poses a headache for central bankers. So you see this thing happening, this balancing act taking place. And what this translates to, in a nutshell for our viewers, is that you'll see a story of two halves in 2023. The first half, you will see inflation, rising interest rates, recession fears about corporate earnings, all those things that I talked about earlier, all those things will need time to play out. You'll need 3 to 6 months of that to play out. In the second half, I think the mood will probably turn a bit more optimistic because if the inflation numbers do come off, so recession is not a bad thing. As Bob said at the beginning of his speech, a recession does happen and inflation does come down, that may be a good thing for investment markets. So first half, great deal of volatility, volatile bottoming out process, as we call it. Second half, you could see a bit of upside and maybe more upside in 2024 when the Fed potentially starts cutting rates.
Yeah, more upside. I'm liking the sound of that. So you've talked about some of the key milestones and that need to happen, right?
That's right.
Before we can see a sustained pickup for the markets, Vasu? Tell us more.
Precisely. And, I think there are various things that we look at, but, I would summarize it as three key factors. Number one, I think inflation needs to clearly roll over, right? And the inflation numbers have been coming down. Problem is they've not come down sufficiently.
Enough.
So the rhetoric coming out of central banks and the IMF is that, inflation is still persistent. It's come off, but it's not come off enough. Most central banks have a 2% target for inflation. Inflation is still way above that. So we need to see inflation coming down more in the coming months, perhaps in the next 6 months, and clearly heading towards the 2%, 3% trajectory. That will give comfort to investors that, hey, it's really finally coming down. And secondly, I think we need to see the Fed language turning more dovish. Right now, the Fed is not there. The Fed is still sounding hawkish. We may have to do things that will not please politicians. They'll be uncomfortable for the markets, but we need to do it. That's what Powell said, 24 hours ago. And so essentially, I think we need to see the Fed language turn. And I think that could happen when inflation comes down meaningfully. And finally, right, Yvonne, I think recession fears need to be sufficiently priced in, right? So as I said, in 2022, the focus was on inflation interest rates, but recession has now come to the forefront in a bigger way, and it's starting to play its hand. It needs to come through in terms of earnings downgrades, because analysts are still fairly bullish on the earnings outlook. We need to see margin pressures taking earnings down. And when that happens sufficiently, then a lot of the bad news or the headwinds that I talked about would have been priced into the markets, and then we reach a sweet spot. And that becomes a very interesting opportunity for investors. So bad news can actually turn out to be good news eventually. So what I take from that poll that we just did was, yes, investors are really bearish, about the economy, about the markets, and so on and so forth. And that may not be a bad thing. There's a very healthy level of skepticism in the markets. And what I see is a lot of cash on the sidelines. If you look at US money market funds right now, they're perched at 4.7 trillion, almost a record high. And so that means there's a lot of skepticism. It also means a lot of firepower could come back into the markets once the tide turns. And that could happen in the next 12, 18 months.
So once we hit that sweet spot then, Vasu, what asset classes are going to be the talk of the town in 2023? Tell us.
Well, I think there are going to be opportunities in both the equity markets as well as the bond markets. So at this juncture, we are a bit more defensive because, as I said, In the first half of this year, we see the markets going through a volatile bottoming out process. But second half, we are probably likely to turn more positive. But right now, we're neutral on equities and bonds overall. But just to share, in the last few months, we've upped the risk ante. We've turned more positive on risk. So we're embracing risk in a bigger way.
Okay.
And so we've upgraded developed market investment grade bonds. We've upgraded emerging market investment grade bonds, emerging market high yield bonds. We've actually turned positive on Asia. Asia is now, we're overweight on Asia. And why? Because we think there are opportunities in China. The Chinese stock market is seeing a beautiful rebound. And we think Asia is going to benefit from what happens in China once China gets its footing. So there are going to be opportunities. It's just that investors have to look out for it. And you'll see opportunities in both the equity space as well as the bond space. And you should not ignore both of them. I think there are going to be opportunities in both. And the sell-off last year has created even more opportunities.
Excellent. Thank you very much. So you were previously neutral on equities and bonds, but there are opportunities, especially in Asia ex-Japan equities.
Definitely. We are overweight on Asia ex-Japan.
And developed market investment grade bonds as
That's
well.
right.
Awesome. Thank you very much,
Thank
Vasu.
you.
Let me now turn our attention to Carmen and get her to share her views on the outlook for the Singapore stock market. We did have a good performance in 2022. What's the reason for the outperformance, and will this rally continue into 2023, Carmen?
Thank you, Yvonne. I think that's a top question on most investors' mind. We saw actually last year that the Straits Times Index actually outperformed most of the key markets, up about 4%, whilst most of the markets were down double-digit, and with some of them actually falling close to 20%. Markets were very volatile last year. So, for example, if you look at the MSCI World Index, from the high to the low in 2022, the decline was almost 29% before it actually staged a rebound of up to about 11 to 12%. So you can see that huge volatility in global equities. But within the Singapore space, that volatility is actually a lot more limited. In fact, the Straits Times Index stays positive throughout almost the whole of last year. So in that sense, in many ways, and we've always said this time and time and again, is that Singapore needs to be part of a diversified portfolio of stock because of the fact that Singapore has a lot more of the value stocks. And in a situation which, like Vasu just painted, where you're going to head into a lot of uncertainty and a lot of volatility, then definitely you need to have holdings in companies or in a market like Singapore, whereby there are a lot more of the value stocks. And you have noticed in recent time that most of the job cuts that are taking place worldwide have actually focused on most of the growth companies. And that, of course, includes your technology companies. So growth companies are a lot more, in a sense, volatile, actually because of the fact that heading into the high interest rate environment and the fact that this is, like what he said, very long-term sort of story, then that volatility will continue into 2023. So Singapore needs to be part of that whole story for your investment, largely because of the fact that going to 2023, I think that Singapore stocks should anchor your portfolio. Moving on to the next slide, please. So you can take a look at the next slide. Basically, this is what is the MSCI World Index in terms of the price-earnings ratio. And you can see that sharp decline, which happened in 2022. And now there's a slight rebound. So in terms of valuation, equities globally are actually not expensive because of this huge correction that took place in 2022. But then again, what about earnings? Earnings remain a very key consideration when you're investing into the stock market, because if earnings come under threat, and that's when your valuation will be thrown out of the window as well. And then the chart on the right will show you the earnings for 2023. And you can see that analysts have been cutting the forecast for 2023 earnings. But like what Vasu said earlier on, there could possibly be more further cuts, especially if the world goes into a major recession. But I think recently, if you take a look at what IMF has said, I think they said about a third of the global economy will most likely hit a recession in 2023. And Singapore, being Singapore, is actually fairly dependent on what's happening throughout the world. So the Singapore economy is not completely shielded from all the volatility in the market, and there will still be some impact. So in terms of the earnings, I think going forward, in terms of 2023 earnings, there will still be a bit more cuts taking place in perhaps the first quarter and the second quarter of 2023. Next slide, please. So, in terms of the Singapore market, it's actually been very interesting. There have been a lot of very positive numbers coming into the market. First, as Selina said, tourists are coming back. So you can see that tourist arrivals have actually been very strong. What's very interesting is that pre-COVID in 2019, the Chinese were among the top 3 groups of visitors to Singapore. And by 2022, which was last year, they almost never make it to the top 5 as well. And with the reopening now, we actually expect that to come back in. And What is very critical, obviously, is the fact that tourism receipt, the biggest group used to be the Chinese. And because of the fact that they actually disappeared from the Singapore market in the last 2 years or so, there's a lot of optimism built into the fact that this year we will be welcoming not only tourists, of course, higher prices, like what I said, higher chicken prices as well too. So that's another very positive indicators in terms of the tourist arrival, and that will definitely benefit a lot of the tourism-related sort of industry, and that of course includes your hotel, your retail. And even some of your malls as well, I think those will also benefit. Your high-end shopping centres and even some of the gaming stocks could possibly benefit from this whole improvement in terms of the tourist arrival. And which is why also, if you take a look at on the right-hand side, retail sales have also started to pick up as well. And that's actually from a very low base, and it just rebounded very nicely recently. Next slide, please. So apart from your tourism and your retail business, one big question that we get asked a lot is obviously the fact that in a high interest rate environment, how is that going to impact the Singapore market, especially in terms of your mortgages? But what is very clear is the fact that household debt, especially as a percentage of the mortgage versus their entire debt position, is actually very low and very manageable. And as we know, the tight labour market in Singapore also means that most people are still gainfully employed. And so as long as the employment number still stays very healthy and you have actually a very low household debt level, in terms of the property market, it is actually fairly healthy still, despite the whole high interest rate environment and the fact that our mortgage rates have actually gone up quite significantly. Can I have the next slide, please?
Yeah, Carmen, you mentioned that Singapore stocks should form the anchor of a portfolio. So what are some of the more attractive sectors and themes for Singapore equities in 2023?
Yeah, I think that's a very good question. I think when you typically talk about Singapore market, you tend to think about banks and maybe perhaps property. If you take a look at this slide, you can actually see that other sectors have also performed very well in 2022, and that includes, of course, your industrial, your energy, which actually benefited from the high oil prices, and of course, some of the telecommunication and utility stocks. Banks have done very well, obviously, so that is also another sector that's done extremely well. And if you take a look at most of the core counters within the STI stocks, you will have noticed that actually these are the companies that have actually ride through the whole Asian financial crisis, and of course, the global financial crisis. And even this round, actually, several companies continue to actually post fairly good gain, even in a very volatile year like 2022 as well. So if you think about Singapore, don't just think about banks or property, think beyond these sectors as well. Next slide, please. So
what is your outlook then for the Singapore property market as well as property stocks? Maybe a different story there, right? Maybe you want to take us through the slide.
Yeah, I think property stocks is one of those very close to our hearts, obviously. But if you take a look at the valuation for the Singapore market itself, I think the Singapore market has actually come off in terms of valuation, despite the outperformance. Actually, the valuation has actually come down to quite attractive levels. So can I maybe just have the previous slides to just show that in terms of the trading for the Singapore market, it's actually still within a very attractive level, which is actually at minus 2 standard deviation below historical 10-year average. That's for price to earnings. But because of the fact that we feel that earnings could possibly come under threat this year, then the other key indicator we look at is, of course, price to book. And even on a price to book basis, it's actually still fairly attractive. And not forgetting the fact that Singapore stocks still give a very good dividend yield of between 4 to 5%. And I know that a lot of clients have actually gone into shorter term sort of instruments which give you about close to 4%. But here we're talking about equities that still gives you about 4 to 5%, plus the potential to participate in the capital upside. And then going on to the whole property sector. The property sector is actually fairly interesting. I think this is one of those curves that a lot of investors will love. It's on a constant uptrend. So if you take a look at both the rental market as well as resale prices, right? I mean, one of the key indicators obviously is the fact that the HDB market is actually very robust. In fact, 11 quarters of quarter-on-quarter gain. So you can see from that sharp, nice chart. I think was almost unseen in 2022 for most of the asset classes. And so once the whole HDB sector is so buoyant, it also means that the residential market is also very buoyant as well. So we actually saw many quarters of quarter-on-quarter gains, both for condos as well as for the landed properties as well. So both sectors have actually done very fairly in line with what is happening in the HDB market as well. So this is a beautiful chart that you're seeing. But unfortunately, if you take a look at the next sets of slides, which actually covers the stock market for property listed companies, it tells an entirely different set of story, whereby actually prices have actually not reacted as nicely as the physical market. So on the left, you have the real estate index. On the right, you have the REITs index. And you can see that both have actually corrected. And part of the reason, obviously, is the fact that interest rate is now trending higher, and there is that weaker sentiment towards property and property-related stock, largely because of concern over how that will impact the mortgage and the ability to service the total debt servicing ratio as well. But can we have the next set of slides? It's the same, but this one actually, instead of price movement, shows you the valuation. So in terms of price to book, you can see that both are actually trading below book. And what is very interesting for the property sector is that it's actually trading almost at 0.6 times books, which means that most of the listed property companies now are actually at a discount of 40% to what is their book value. And even if you put in a discount at the fact that the book value could come under stress because of the whole recessionary environment we're going into, at 0.6%, I think that there is still value in the property sector. And obviously for the REITs market, that nice correction also means that at this point in time, REITs are actually no longer as expensive as perhaps maybe 1 to 2 years ago. So again, there are opportunities to actually pick ideas within the Singapore REITs market. So next slide, please. So before I end, I just want to just share some positive note. This is the MSCI Asia X Japan Index on the left-hand side. For 17 months, the market has actually been downgrading the outlook for the whole sector, which means that in general, investors and analysts are actually fairly negative on the Asian market for about close to 17 months. But if you can take a look at towards the tier end now, which is the recent 1 to 2 months, that pessimism seems to be disappeared, and now you can see a little bit of optimism creeping into the market. This I would consider more like a green shoot. And similarly for the FY 2024 earnings, that's the next year's earning. Again, I think there is a bit of this whole pushback into the next year's earning. So in terms of the 24 earnings now, we again see that people are now a little bit more optimistic, and there's that slight uptick. So on that note, it's also good to know that we started the year quite positive. This is 2023. We are now into the early part of 2023, and yet you've seen that equities have actually rallied very nicely, largely because the Asia reopening. And as I think Vasu shared earlier on, we are quite positive on the Asia market, and within Asia itself, we are positive on a few markets, and that includes Hong Kong, China, and of course Singapore as well.
Thank you, Carmen, for taking us through that. I feel that for this year, we should be treading quite carefully, but there are so many silver linings that each of you have pointed out. So let's move now to the Q&A session, and I will be taking questions from the audience. So my bad, it's not a QR code, but there is a Q&A button that you can just click on to enter and then key in your question at the bottom of the slides on your screen right now. And we have a couple of questions that have already come in. So let me start with Selina first. And this is really rather an observation of the situation in the last few days, right? So as we said, the spotlight is on China's reopening, lots of excitement, also a little bit of a double-edged sword there. And even as the world prepares for the return of outbound tourism, Chinese tourism to the rest of the world, we see other countries imposing travel restrictions on Chinese tourists. But at the same time, China has also retaliated by, for example, stopping the issuing of short-term visas to South Korea. A little bit of tit for tat there. So how do you see the situation playing out in the next few weeks or months?
Well, it's a little bit of a delicate situation right now.
Exactly.
People are worried that China, because of the rapid rise in terms of the COVID infections, may potentially risk exporting COVID cases or new variants around the world. Hence some of these stricter restrictions on inbound Chinese tourists. But I think this tit for tat thing probably is going to be more verbal jawboning. I think we're just going through this hump to a large extent. I do expect that the noise level will probably fade with time. I think so far a lot of countries don't suggest that they are seeing more severe new variants coming out yet. But we really have to wait and see in the next couple of weeks and months. We have been through this process, I would say, because a lot of the Asian economies reopened earlier last year, right? So I think the time horizon for China probably is compressed a little bit because of the very rapid pace of reopening. But I suspect, by 3 to 6 months' time, we will have a good fix and some clarity as to whether we should be that fearful of potential new variants coming out. I think we have to bear in mind that we've come a long way in the last 3 years. Vaccination rates are a lot higher. Most of us have taken our booster shots. And if you couple with the fact that a certain proportion of people have got infected before, I think there's a certain level of relative immunity going forward. So I would say markets will have to take this in the stride. As with any sudden change, we will have to brace ourselves for a little bit of volatility and uncertainty. But I think, China is a very major economy. This reopening can only mean good news for both the regional and the global economy.
One more question for you, Selina, on China before I move to Vasu, and that is a common concern that's coming up. Will China's reopening exacerbate global inflation, or will we see some inflationary spillover to ASEAN economies and here in Singapore? Or what is ultimately the net impact?
I think in the short term, it's quite interesting to look back at how oil prices have performed since the start of 2023. If people had drawn the logical deduction that, China's reopening means growth is going to come back, China's industrial activity is going to come back with vengeance, then you would expect that all demand would be priced in, and hence all prices would have risen. But actually, what you saw in the first couple of days, trading days in 2023, is that all prices actually fell. And this comes back to the story about short-term pain versus longer-term improved growth prospects for China. So in the short term, actually, because of the COVID waves and the peak infection levels, there is a definite dampener on the short-term economic activity, industrial activity in China itself. How long this process is going to take before China reaches herd immunity, no one really knows. But I think the sense is that it's going to be a story where demand is going to be a bit lower in the near term before it picks up more strongly in the second half of the year. So, like I mentioned earlier, for ASEAN, we're kind of in a very interesting juncture right now. Because growth has been fairly resilient last year, we do think that ASEAN is quite well positioned this year as well to, withstand some of the challenges of a synchronized slowdown in the major economies, and largely because we're going to benefit from China's reopening as well when the tourist comes back. But I think going forward, if China tourists and demand comes back in a strong fashion later part of this year, it's going to basically drive services demand, for instance.
Sure.
And that may mean that inflation may stay elevated and it will not drop as fast as what we could potentially see in the major economies where they are facing recession stories.
Certain red flags to watch out for. Thank you, Selina. Coming to you now, Vasu. There's a question on developed market investment grade bonds. So OCBC is bullish on that as an asset class for 2023. Could that be used as a hedge against recession?
I think that is one of the reasons why we are more positive on developed market investment grade bonds. We feel that, it tends to perform better in an environment where there's going to be a recession, right? Because it provides safety, less risk of default, and so on and so forth. And also the valuations have now become attractive because the sell-off in the bond market, valuations are attractive. So clearly that's one space you want to be in. And looking further out into 2024, 2025, right? I mean, if, for example, inflation does come down, even if not this year, maybe more significantly in the next 2-3 years, then what's going to happen is clearly the bond markets will benefit. Lower interest rates will benefit the prices of bonds. And, so again, investment grade bonds with a longer duration will benefit from, lower rates, if not this year, maybe in 2024, 2025. But as you know, the markets don't wait for rate cuts to happen before they react. So the markets tend to react ahead of time, right? So we could see a bit more fireworks, with this bond. So it's a double whammy. It provides a shelter from the global recession. At the same time, it's going to benefit from potentially global recession because if it translates to lower interest rates, it will also benefit the asset class.
Gotta have that in your portfolio. Speaking of portfolio diversification, besides that traditional 60-40, right? I mean, markets have evolved, so investment portfolios must also evolve. What, in your opinion, makes for a well-diversified portfolio, given the environment that it's a highly complex one this year?
Yeah, last year with both equity markets and bond markets down, a lot of questions were raised as to whether 60-40 makes sense.
Exactly.
Right, 60% equities, 40% bonds. But let's go back to the underpinning behind what this 60-40 is all about. It's really all about diversification. That's what it means. It may not necessarily be 60-40, it can be 70-30, 80-20, depending on your risk profile. So there isn't a one size fits all answer, right? It depends on how young you are, how much risk appetite you have, what life stage you're in, and so on and so forth. So it's got to be customized for every individual. And so for a younger person, for example, it may be 80-20, 80 in favor of equities, 20% in favor of bonds. For somebody who is maybe in their 30s, early 40s, it may be, 70-30. As you become older, then, essentially it could be a bigger percentage of bonds. But I think the basic message is keep a diversified portfolio. Do not throw all your money into equities or into bonds. Have a mix of both. They're not mutually exclusive. And within the equity space, stay even more diversified. Don't throw all your money into Asia, Japan, just because we sound positive.
Right.
Don't throw all your money into China because we sound positive. Right? And don't ignore the tech sector either because, it did so badly last year.
So are you expecting a comeback for the tech sector?
Well, I think technology at this juncture, our call is neutral. We are neutral in the tech sector, Yvonne, so we're not negative. We are neutral. So don't forget, there's been a big sell-off in the tech sector, and valuations have now come down to more attractive levels. But just to give you an idea of the valuations now, if you pick the MSCI global technology sector, the forward 12-month price to earnings ratio is about roughly 20 times. How does that compare to the 5-year history? Now, if you go back to the COVID-19 crisis, when the markets plunged, the valuations fell to as low as 16 times. Now we are 20. If you go back to 2008, or rather, if you go back to 2018, the trade war between US and China, it fell to about 14.5 times. So, it's not as deep value as, those two episodes, trade war and COVID-19 outbreak, but it's now close to 1 standard deviation below the 5-year average. So it's trading below the 5-year average. So value is emerging. Don't take your eyes off the sector.
Okay.
Further weakness will present an opportunity because when risk appetite comes back, just like China was hammered and has seen a big rebound, tech sector will also see a big rebound when risk appetite returns.
Okay, so not one to be discarded yet or forgotten.
Definitely not.
Any more upside for gold prices? A question that came in.
Our view on gold prices for the next 12 months is $1,850 an ounce. But a lot hinges on 2 factors. One, Fed policy, interest rates, and the second factor is US dollar direction, right? And at least in the first half of this year, interest rates are going to hit higher. So it's a kind of a headwind for gold. But nevertheless, gold has done well since October last year. It's actually appreciated 16% because I think the markets are now focusing on recession. So markets are looking forward and saying, fine, rates are going to go up in the first half of this year, but they might level off and then come off subsequently if inflation comes off because of recession, right? So recession is good for gold. US dollar is losing some of its shine, its win. And if it comes down, gold becomes cheaper in US dollars because gold is priced in US dollars. So I would say you must have some gold in your portfolio. It's a hedge against major uncertainties. It will go up and down. Don't overinvest in it. Have a small percentage, maybe 3%, 5% of your portfolio in gold. It's like buying insurance, right? A portfolio insurance, it gives you a bit of protection.
Yeah.
Right? Don't expect a lot of fireworks, given the fact it's actually done quite well in the last few weeks, months. But we think you should have, everybody should have some gold in their portfolio.
Yeah, so worth padding your portfolio with some gold. Thank you, Vasu. Carmen, your outlook for the S-REITs, please.
Okay, I think that if you look at the S-REIT sector, it has actually corrected quite nicely, largely because of the fact that interest rate is actually on an uptrend. And obviously, when in a high interest rate environment, I guess REITs, which are obviously more interest yielding sort of asset class, tends to underperform in this environment. But having said that, if you look at the Singapore market, we definitely underperform in terms of the sector. REITs is one of the worst performing sector. But versus the global market in terms of the decline, the Singapore REITs have actually outperformed global REITs. So in some way, I think if you take a look at the Singapore REITs, especially the bigger ones, and we have got fairly big REITs which are listed here, they have actually done fairly well, largely because of the fact that I think they offer a very wide diversification. So within even their asset class, some of them are in industrial, some of them in hospitality, some of them in data center, within their asset class, they have actually got geographical diversification. And so one good example, of course, is your hospitality REITs. They can possibly be operating out from Singapore, Europe, China, etc., etc. So in a situation whereby a lot of the markets are actually reopening now, I think the hospitality REITs are actually positioned to actually see much better occupancy rate as well. So again, we kind of prefer the REITs which are bigger, have got much wider global exposure to different markets. And again, this year could possibly be a very soft year for REITs. But I think if you look beyond like 2 to 3 years. I think REITs are, again, I think something you should, a bit like gold, you should have a bit of it in your portfolio as well.
Now, Carmen, I know you've implored our audience to look beyond property, and you also give an airing to other themes and other sectors, but there are still questions coming up about what is your current sentiment for the resale and new launch sectors of the property market this year?
Putting into context the fact that property prices have actually almost risen for like 2 years in a row, this year the increase will be a lot softer than the last 2 to 3 years. I mean, I think most sectors have, both the HDB as well as the private property sectors have gone up almost close to 20% for the cumulatively for 2 years. So to expect that same kind of level of increase for 2023, I think it's a bit unrealistic because of the fact that first, the base has gone up higher. Secondly, we still do continue to have cooling measure which were introduced in September of 2022. Together with that, this whole total debt servicing ratio came into play as well. So that could possibly also pose a little bit of challenge. So in terms of the new demand, I think that could possibly taper off a little bit. So this year, for residential property, I think we're going for perhaps mid-single digit increase in price. HDB most likely could possibly fare much better. Again, also single digit, but perhaps slightly towards the higher end of single digit growth level. So do not expect the same strong double digit growth, but I think there will still be a small incremental improvement in prices for both the HDB sector as well as the private residential sector as well.
And you know, in the past few years, Carmen, there's always been this ongoing debate about growth versus value stocks, value to rotation to growth again. What are your thoughts for this year? How is that going to play out? Still room to have both in the portfolio, growth and value? For the Singapore?
As you rightly pointed out, I think technology stocks have actually been bashed out, largely because they are considered to be growth sector. But having said that, we have actually seen that for a lot of the technology and even growth sector, policy changes actually can happen very rapidly. And if you look at, for example, recently in China, more gaming programs were approved by the government, and also the fact that one of the key financial stock, Ants Financial, actually got financing as well quite readily. So again, when the climate changes, it can be very fast. So we do not advocate being totally out of growth stock just because of the fact that they are more at risk, and also because of the fact that this round, in fact, for the first and second quarter of this year, we believe that technology stock could possibly lower the guidance in terms of the outlook. But beyond that, it could possibly be improved. There could possibly be improvement, but the cut will come from two areas. One, revenue cut, and secondly, cost cut as well. So we've actually seen that growth stocks are a lot more aggressive in terms of cutting jobs. So you can see definitely improvement, and like I said, it comes from two areas, revenue as well as. So net, it could possibly not be as bad because of the fact that you've actually cut your costs as well. So overall, I think that if you can bear with the first 1 to 2 quarters of a lot of volatility in terms of the earnings for higher growth companies, I think beyond that, third to fourth quarter, the outlook should still be much better than the first half.
Yeah, I'm looking forward to that as well. Thank you, Carmen. I want to circle back to Selena, but I don't combine a couple of your currency queries for Selena. So would you say the US dollar has topped out? If so, what is the outlook still for the USD, and what's the next best safe haven alternative currency?
Well, actually in 2022, the dollar was king. It basically appreciated on the back of the strong US economy and a very, very aggressive Fed tightening cycle. I mean, if you look at the US economy, it's still holding up. The labor market actually is fairly resilient at this point in time. Of course, it could hit a bit of a soft patch later part of this year if the Fed continues to insist on raising rates and keeping rates higher than what market is expecting. So I would say that the consensus trade to be long dollar is probably over. The tide has turned. But, you know, as in all things, currency markets are very fickle. They move very, very quickly, and they try to anticipate what's going to be happening the next 6, 9, 12 months down the road. So I would say that it's not going to be a single direction type of trajectory for the dollar lower, even though our medium-term bias is probably that the dollar is a bit toppish and has some downside room later part of this year. This basically recognizes the fact that the Fed is approaching the end of its rate tightening cycle. So even if they don't cut rates from here in a short order, nevertheless, you know, the yield differential, I think for now, is still in favor of the US. I think the other point to watch really is that, you know, with China's reopening, risk sentiments have improved, especially in this part of the world. So barring, you know, big swing back to risk aversion on possibly this whole global recession story, then that would favor the flight to quality back into the dollars. So if risk sentiments remain fairly supportive, this whole idea about bad data is good news for markets kind of story, then actually that would not be so conducive for the dollar in the short term either. So it's not going to be a straight path, but I think it looks like, the consensus trade to be long dollar is probably going to be unwinding.
So then the safe haven alternative? SGD,
well, I think there's quite a few that is quite interesting to look at. For instance, if you look at Japanese yen, because the Bank of Japan actually did their yield curve control tweak a little bit earlier than what people were expecting.
Okay.
So that got people very excited. And I think there are two things to watch out for. First is that Japanese inflation numbers have actually been exceeding their target. So if it stays persistently higher than the target, then there's room for further policy normalization on the part of the BOJ. So there's a lot of market speculation right now that, come April, when the current BOJ governor, Kuroda, steps down, the new person taking over, would he actually be an advocate of possibly doing more YCC tweaks, or even possibly, exerting, their NIRP policy, their zero interest rate policy altogether. So that's got markets very excited about the Japanese yen. Second thing to look out for, with China's rapid reopening, there's probably potentially a lot of inflows going back into the renminbi and also renminbi assets. So there is a potential upside from here. And then if you look at what story, what currencies are kind of tied to the China reopening story. So if it's tourism related, it could be things like your Thai baht. And if it's proxies, then it could be things like your Korean won as well. So there are quite a few interesting currencies that I would be keep, on my watch list from here.
Interesting play there. Thank you, Selena. Well, still staying on China, Vasu, we said you're bullish on Chinese equities. How about your outlook for Chinese property stocks?
Okay, interesting question, Yvonne. I think we have to draw a distinction in China between the property stocks and the property sector. And what I mean by that is the physical property sector. So as Selena highlighted, you've had a slew of easing measures. Not the big bang approach, but a slew of easing measures since November of last year. And that has actually given the property stocks a big boost. So just to give you some perspective and some numbers, right? So since the bottom in the fourth quarter of last year, the MSCI China Real Estate Index is up by almost 70%. 70%, Yvonne. That's a very sharp move in property. So property stocks have taken heart from the moves by the government to ease up on regulations and tightening and help developers' liquidity. So, but on the other hand, the MSCI China Index is up by just slightly over 40%. So the property stocks in China have outperformed the Chinese market overall. And that's understandable because property stocks have really taken a very bad beating and value is starting to emerge. But of course, we feel that the property sector is such a big animal. The problem they have in China is so huge, it's not going to go away overnight. It will be a process. The government has started a process of trying to provide support to the sector. Of course, the stock market, in its typical fashion, pushes prices up in a euphoric manner. But that doesn't mean that the trend is going to be one way and only one way up. So investors have to be careful, right? There will be property developers that will continue to face stress. Some will default, and you don't want to be in that space. On the other hand, there'll be other property developers in the state-owned, which are state-owned, SOEs, for example, in China. They could benefit because they may have a stronger balance sheet, government support, and they could benefit from what's happening with the distressed companies. Because the distressed companies, the ones that are facing pressure, they're going to take their business away from the property sector or scale back. When they scale back, opportunities are going to be there for the stronger players in the market, and they could gain market share, right? But again, this is not an overnight process. It's a gradual process. As I said, in the physical property market, you have not seen a big surge in prices. But in the stock market, property stocks have surged because, people are just, it's what we call revenge buying, right? Like revenge spending, right? But so you've got to be careful not to get carried away either with the euphoria. But having said that, the direction is clearly one where the government wants the property sector to stabilize. They want to prevent any kind of systemic risk. But there'll be winners and there'll be losers. And I think it's important to identify the right stocks. And this is where, our viewers or Premier customers can talk to their RMs and find out, some of the winners that they can keep an eye on.
Some prudent advice there, not to get too caught up with the euphoria.
Precisely,
yeah.
precisely.
And there's a question here about ESG investing, which perhaps you can take in the absence of Kevin here for the panel discussion. And that's, how do I go about investing in ESG related themes or funds?
Okay. So, I think Kevin did highlight at the end of his presentation, there are investment options. Speak to your relationship managers and so on and so forth, And ESG is an up-and-coming theme. It's a mega theme. And like he said, you cannot ignore the theme. You need to have it in your portfolio. And one way you can do that is through perhaps invest in funds. In other words, unit trusts, right? So I think the advantage of putting your money into unit trust funds is that you get the expertise of fund managers who are professional investors. You get the expertise of international fund managers, who understand this space quite well. And you get the benefit of diversification. You don't want to throw all your eggs into just one or two baskets, right? And I think clearly that's one way to do it. Of course, there are other ways you can do it. Like for instance, in OCBC, our robo platform does offer options, like for example, electric vehicle portfolio, impact investing portfolio, and even a low carbon ETF is available, right? So essentially there are options out there in the market. And I think the key message that we have today is that, aside from technology being a mega theme, I think ESG is clearly a mega theme you cannot ignore, because 10, 20 years down the road, our lives are going to be very different. And you need to have some money invested in this space for sure.
Yeah, I agree. Thank you, Vasu. And still coming back to Carmen now, when you expect interest rates to peak or come down, inflation to come down in the second half of this year, interest rates to come down in the second half of this year, which sectors are most likely to benefit? Which sectors in the Singapore stock market are most likely to see a good rebound?
I think one of the clear beneficiary of this whole high interest rate environment is obviously the banking sector. We've already seen that in the third quarter results, whereby actually the banks have actually reported very strong set of earnings, largely because of the fact that they actually benefited from high net interest margin. And the interesting thing about the interest margin part of the business is, of course, the fact that we are still not getting as high for our deposit rate, but the rates have already gone up. So that's where the differential. And the differential, I think, will continue for at least another 1 to 2 quarters. So you could possibly still see very strong earnings for the first quarter up to perhaps even the second quarter of 2023. And that should still continue to make sure that the banks deliver very good results. And having said that, if you look at the banking stocks, on average, most of them are giving you close to about 4% dividend yield. Again, very attractive. So you get to enjoy in terms of the capital upside and also a very decent sort of 4% dividend yield on an annual basis.
Thank you, Carmen. And another quick question for you, Selena. Your outlook for the global semiconductor industry?
Well, that's going to be quite challenging in the near term, because I think we've had, past 12 to 18 months of very, very strong growth when everyone was pivoting to a work from home environment. I think now that most people are moving back into the office, and then all those fears about the global recession being imminent upon us, I think there's going to be a scale back. And of course, the rising interest rate environment, like both Vasu and Carmen was suggesting, it's actually not that conducive for tech stocks. So I think it's going to be, after what we call 7 good years, you're probably, hopefully not facing 7 bad years, but it's going to be a challenging time. I think the structural story behind the short-term pains, also that if you look at US-China relationships, it still remains fairly complicated. In fact, if you look at the US CHIPS Act, they don't want to sell sensitive semiconductor equipment to China, right? So that's going to impact China's value chain as well. And I think China, in its own defense, will also try and ring fence and create its own ecosystem. So you potentially could see polarization of some of these technologies. That's a more medium-term trend, but I think short-term we are grappling with a slowdown in terms of chip demand and also the whole global economy slowdown.
Thank you, Selena. Now, Selena, Vasu, Carmen, I'm suddenly getting an influx of a lot of questions as our Q&A is about to wrap. There are questions about, should I allocate more of my portfolio to equities? What is the potential returns for the bond markets? Do you think the US-China tensions will be the biggest geopolitical risk? And if a recession is coming our way, should I just hold cash or should I stay invested? So lots of these questions coming in. So why don't I, for my wrap question, let me ask each of you then, how should investors best position themselves for recovery in the second half of 2023, given that there's been a consistent message that investors should be bracing for more uncertainty or a little bit of pain in the first 2 quarters of this year? So let's start with you first, Selina.
Okay, sure. I think we are right to be a little bit cautious because of all the macroeconomic and geopolitical headwinds. But I would emphasize that as an investor, you have to be opportunistic. So China's rapid reopening is a silver lining. I think we have to look for the tide to turn, right? Last year was a bad year for both US equities and bonds. It's very unlikely you're going to see a repeat of that again this year. And I think if we are really approaching the late cycle tightening cycle for a lot of the major banks, including the US Federal Reserve, actually there could be potential upside, even though short term we do think that there could still be exaggerated volatility.
So be opportunistic.
Yes.
Thank you, Selina. Vasu?
I would say guarded optimism. Timing the market is a very difficult exercise. Time diversification would be a better thing to do. In other words, we talk about diversification from a portfolio perspective, but when I say time diversification, I mean spreading your investments out over the perhaps next 6 months, 9 months, 12 months, so that you don't try and pick the bottom, but you invest gradually over the next 6 to 9 months. As Selina said, I just want to point out one thing. If you look at the history of the S&P 500 index, right, going back to 1928, there have been only 4 occasions when the index is down 1 year, it continues to be down the following year. Only 4 occasions, right? So it was a down year last year for the S&P 500 index. So the odds are stacked that, we're going to see a up year in 2023, and investors don't want to miss the boat. But then again, the first half is going to be a tricky, volatile period. Nobody can pick the bottom. It's very hard because there are too many moving parts. So spread your bets out over the next 6 to 9 months, dollar cost average, time diversify.
Timed diversification. So I'm expecting portfolios to be very robust there. And you actually preempted a question in the Q&A, which you didn't see, which was when exactly will the markets bottom out? When exactly will recession come in, hit us, and then leave early? Thanks, Vasu. Carmen.
Okay, I think in terms of the risk-reward ratio, we most likely is at a point whereby it's actually looking quite attractive. Largely because of the huge correction that took place last year. So this year, in terms of risk-reward ratio, is actually looking a lot better than perhaps maybe 6, 7, 8, 9 months ago. And like what Vasu said, it's very rare historically for a market to go into 2 consecutive years of massive correction, unless it's a black swan event. And I think that we have already anticipated a lot of the uncertainties. And equity market in general tend to be forward-looking. And if you're looking about forward, which means you're looking at 6 months ahead or 8 months ahead, we are talking about a much better second half. So I think that it's time to start to slowly look into some equity position as well.
So focus on equity positioning.
Yep.
Would that be it? Yeah. Thank you, Carmen.
Obviously, again, like what he said, not 100% equity.
Yes.
It's all about diversification.
Yes, that's right.
It's all about diversification.
So thank you very much to my panelists for addressing really the pressing questions that are top of mind for investors. We covered the macroeconomic outlook, the global and market sectoral plays, and our panelists also highlighted the key investment opportunities not to be missed. So there's bullish on developed market investment grade bonds, bullish on Asia ex-Japan equities, Chinese equities. But as they've highlighted as well, don't put your eggs in one basket. And I think 2023 should certainly be a much better year, especially in the second half, once we get over the pain of the recession, if it comes and hits us early and leaves us quickly. And that is if we continue to heed the advice of our experts tonight to be opportunistic, to make sure that your portfolio has a timed diversification, and of course, maybe shine the spotlight a little bit on equity allocation. 2023 may be the upside here that we're all looking forward to. So thank you very much to Selina, Vasu, and Carmen. And to you, my online audience, thank you very much for your active participation tonight and for all your questions that have come in. On behalf of OCBC Premier Banking, we want to thank you for joining us this evening. And we do hope that you've gained some valuable insights from our panelists as you navigate the markets in 2023. Before you go, please do spare us some feedback so that we can continue continue to provide you with useful and informative content. My name is Yvonne Chan. Have a good rest of the week, and we look forward to seeing you next time. Good night and bye-bye.